Hello and welcome to a new episode of Money with Monika. We're talking about the exchange traded fund or ETF.
An exchange traded fund which has some of the attributes of a stock, but it isn't. You can get prices through the day as the NAV moves up and down. People actually got to know about ETFs because of the gold whole focus on the gold prices. You need to look at three things when you are choosing. One is the cost of the two. The second is the tracking error. And third is the liquidity. Use the passive way to at least start tasting what equity investing is all about.
Hello and welcome to a new episode of Money with Monika. We've gone over the ins and outs of mutual fund investing so far, and we've even touched upon fund categories and the underlying stocks. But there is another instrument which, while it's listed on the stock exchanges, it's not quite in the same category. We're talking about the exchange traded fund or ETF. So, Monika, we'll start with the most basic questions we always ask you. What is an ETF?
Right. And that's what the mutual fund investors say. You just keep complicating our lives. It's never done. There's always just more to understand. So we'll just go back to the first lessons that we learned, that there are two ways of investing, active and passive. Active is when the fund manager makes choices. Passive is you're simply mimicking an index. An index could be, for instance, the Sensex, the Nifty 50, a mid-cap index, a technology index. If there's an index, you can have a passive style of investing on it. And there are two ways to do it. One is through an index fund, which is a mutual fund. It has all the attributes of a mutual fund, or through an exchange traded fund, which has some of the attributes of a stock, but it isn't. It's still a mutual fund. The difference is that an exchange traded fund is listed on a stock exchange, whereas a mutual fund does not need to list. So for an exchange traded fund, you need to have a demat account to access the exchange traded fund. In an index fund, the price at which you buy and sell is the price at the end of the day. There's one price that you will get. An exchange traded fund is far more like a stock that you can move, you can get a price real time through the day. So whether you're buying or selling, you can get prices through the day as the NAV moves up and down. NAV is price. So it's essentially a different flavor. An ETF is more geared towards more of a speculator rather than a pure investor, because if you're wanting that exact price, then it's a different flavor of the product. And also there's a difference in costs. Usually index funds cost a bit more, although in India now you have very, very cheap index funds. And in an ETF, additionally, you're giving the cost of a demat account. When you have a demat account, you'll have to pay the annual fees. So there are all of these differences, and an investor really has to choose what suits his or her motive of buying that product.
Right. Got it. So also ETFs span across asset classes, right? I know for one that gold ETFs really caught people's imagination around 2012, 2013. And that makes sense because Indians are kind of obsessed with gold as an asset, but they don't seem to have the same appeal that they had before. What is this? Why is that happening?
So the three asset classes which today are bought and sold through the Indian mutual funds is equity, which is your stocks, debt, which is all the bonds, and gold, through gold exchange traded funds. And you're absolutely right. It was that 2012 period where people actually got to know about ETFs because of the gold whole focus on the gold prices, and people wanted to buy gold through the exchange traded funds because a lot of investors figured out that was a real cheap way to hold gold. Two things happened. One, the prices of gold really fell down. Right now they're up as we we're in October 2020, but we've had a whole bull run in gold, so that has changed. But gold ETFs haven't really come back into the flavor because meanwhile, Government of India launched the sovereign gold bonds, and these actually work out much better in terms of cost, and also they give you a little bit of an interest, and they're capital gains tax friendly. Investors sort of have moved on, and an additional reason of ETFs not being so well known is also a part of the sales, where managed funds do get higher trail commissions than the other products. So those are simply the ones which are sold more.
So we were talking earlier about how ETFs and index funds are essentially alternatives to each other in a way. So what should we keep in mind when we're choosing between the two?
Like I said, Nilanjana, it is really about who you are and how you see yourself. So if you are thinking about using mutual funds to move in and out of an index, you're playing on that daily little bit of blip up and down,
right?
Then you may be wanting to use an exchange traded fund, or you are sitting in a large corpus and it really matters to you that you get an intraday low on that index that you have chosen. My sense is most retail investors don't think like that. And actually, over the long term, the exact price at what you buy smoothens out over time. So for real retail investors, index fund is absolutely fine, but you do need to look at 3 things when you are choosing. One is the cost of the two. The second is the tracking error. And third is the liquidity. Mostly we find that ETFs are cheaper. But like I said, there are index funds on the broad market in the indices, which actually are doing, expense ratios of 10 to 15 basis points. And if you go direct, that's really a cheap way to hold an index. The second is tracking error. So remember, when we're buying a passive, we don't want the fund to outperform the index. You want something which just mimics it. And the difference between the index and your fund return is called a tracking error.
Okay.
So you want the tracking error to be very, very tiny.
Right.
And you want liquidity. So a part of the problem with ETFs is because, so many investors haven't found this route yet. Sometimes liquidity could be a problem in certain ETFs. Whereas in an index fund, there is enough room available for the fund manager to provide that liquidity. So for retail investors, I would just say, look at the tracking error, look at the cost, and then make your decision.
Right. Okay, so on that note, we'll just take a quick viewer question. Suneha, who's from Pune, writes to us saying that I recently started investing in funds, but I find it very difficult to choose them. There are so many funds and they all sound the same. How should I go about choosing the right fund for me?
Suneha, it's everybody's problem. I mean, you open and you're just struck by what is out there. So 2 routes actually. One is find a good financial planner, somebody who takes a fees and puts you onto the direct plan. That's a sure way of looking after your money long term. A second route is if you want to do it yourself and you simply are frozen, then you use the passive way to at least start tasting what equity investing is all about and what investing through mutual funds feels like. Typically, having half of your money in a large cap fund, a quarter in a small cap, and a quarter in a mid cap, using index funds is a great way to at least start building your basic portfolio. So go passive till you have the confidence or the services of a planner to go active.
Right. So Neha, I hope that answers your question and helps you make your choice. And that's all the time we have on this episode of Money with Monika. But we'll be back with another episode very soon. So keep watching. And in the meanwhile, if you do have any questions for Monika to answer, write in to us at moneywithmonika@lightning.com.
An investor education initiative by ICICI Prudential Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.